So you want to know if this recent market dip is like a sign of more to come.
Especially with all the post-election buzz. And yeah, that's smart to think big picture. We've got a good mix of stuff you sent over, like that market analysis video, that Bank of America report, and some news on Shopify. So let's just dive in. The markets have been, well, kind of jumpy lately. The Dow Jones, S&P 500, and Russell 2000, they're all down.
Yeah, and what's interesting is that this dip, it's happening when, well, there are some pretty big shifts in how investors are feeling. Like that Bank of America report, that's a great example. It shows a huge swing from all that pessimism before the election to, well, almost like they're overly excited about economic growth and inflation.
Yeah, it's like everyone just decided to have a party all of a sudden.
Right.
But what's making this happen? Is it just because of the election, or is there more to it? Well, the election is definitely part of it, but we got to think about other stuff happening in the economy too. Inflation seems to be cooling down a bit, so that gives people a little more room to breathe in their budgets, and that could mean people will spend more, which could then boost how much companies are earning, and, well, market optimism.
Okay, so it's not just like a political sugar rush or something. There's real economic stuff going on too. The report mentions that fund managers are taking more risks now, going for things like small cap stocks and high yield bonds.
Exactly. And on top of that, the amount of money going into U.S. stocks is at a high we haven't seen in 11 years. Almost 30% of fund managers are putting more into U.S. stocks than they normally would, and there's a lot of focus on tech and emerging markets too. So everyone's looking for growth. But, and this is important, things are also priced really high right now. Like the forward price to earnings ratio for the S&P 500, it's at a point we haven't seen in years.
So are we like setting ourselves up to fall? It feels like, that classic irrational exuberance kind of thing.
Yeah, it's a valid worry. It's great that everyone's optimistic, but we can't just ignore the chance that things could change fast.
Hmm.
With interest rates still around 5%, these high prices could become a problem if earnings don't keep up. It's a bit of a balancing act right now.
Okay, so we've got this interesting, tension, right, between feeling good and maybe things being priced too high. But what about everyday people? How are they feeling about all this? The report talks about consumer spending, right? So what's the story there?
So this is where things get, well, a little more complex. The data shows that spending on essentials like groceries and gas has actually slowed down.
Which, at first, sounds bad, right? Are people tightening their belts?
Not necessarily. Remember we talked about how inflation's cooling down? Well, this is probably because of that. As prices level off, people have a little more wiggle room in their budgets, and they're choosing to spend that extra cash on, fun stuff like dining out, entertainment, that sort of thing.
So it's not about cutting back. It's more like shifting what they're spending on. Instead of just the basics, people can, treat themselves a bit more.
Exactly. And what's even more interesting is that this isn't just one group of people, it's happening across all income levels. The report shows incomes are growing for everyone, which is adding fuel to this shift towards, well, what we call discretionary spending.
That's awesome. It means more people can enjoy life, not just survive.
Yeah.
You know. And speaking of spending, that brings us to Shopify. They're a company that seems to be riding this wave of, consumer happiness, like a pro surfer or something.
Yep.
Their performance lately is pretty wild, right?
Absolutely. Their revenue growth in the third quarter was incredible, up 26% compared to last year. They blew past everyone's expectations and earned over $2 billion. But it's not just about those big numbers. What's really cool is what those numbers tell us about, the bigger picture.
Okay, so break it down for us. What are these numbers saying to you?
Well, their subscription revenue, which shows how many businesses are using their platform, is way up. This means more and more businesses, from tiny startups to big brands, are choosing Shopify to run their online stores. And it's not just about getting new customers. The revenue they get from helping those businesses actually sell stuff, that's gone through the roof too.
So businesses that are already using Shopify are doing great, new ones are joining all the time, and everyone's making money. Sounds like a recipe for success.
It really does.
And this isn't just in the US, right?
You got it. Their international growth, especially in Europe, is a huge part of their story. They grew by over 35% in Europe alone.
Wow, Shopify is becoming a global powerhouse. And what's even more impressive is that they're saying they'll grow even more next quarter, between 25% and 29%. That suggests online shopping is going to have a really strong holiday season.
For sure. And if we connect this back to the market stuff we talked about earlier, it makes you wonder if things are shifting. Maybe that initial focus on certain sectors after the election is now broadening out to include e-commerce and those consumer discretionary stocks. Shopify's success definitely supports that idea.
It's like a wave building, and Shopify's right there, ready to ride it. But what about the bigger picture, the overall economy? What's the Federal Reserve doing with all of this? Are they just watching from the sidelines, or are they getting ready to jump in?
That's a great question, and it brings us to what a couple of important people at the Fed have been saying, Kashkari and Barkin. It seems like they're kind of in a holding pattern right now, saying that the current policies are still, a bit restrictive. That means there's room to maybe lower interest rates if the economy needs a little push.
But they're not exactly rushing to do anything big, are they? They seem to be more like, let's wait and see, you know, gathering more information before deciding what to do next.
You got it. Barkin, for example, laid out two possible scenarios that the Fed is thinking about. In one, all this post-election optimism leads to more investment and hiring, which could push inflation up. But in the other scenario, businesses might start cutting costs to keep their profits up, which could lead to job losses and make the job market less stable.
So it's like a fork in the road. One path leads to more growth, the other, well, maybe things get shaky. And the Fed is standing there looking at the map carefully before deciding which way to go.
Exactly. They're being very data-driven, which makes sense.
Yeah.
But this uncertainty about what they'll do can ripple through the market.
Right, because investors don't like uncertainty. It makes them hesitate to invest, which can then affect how much the market goes up and down.
Yeah.
And that volatility, well, that affects everyone, including you. So what does all of this mean for you, the listener? That's what we'll unpack next.
Yeah, it's a bit like watching a chess game. Each player, the markets, the consumers, the Fed, they're all making their moves, and we're trying to, figure out what they'll do next.
And we're all kind of on the edge of our seats wondering who's going to make that big, bold move next. So let's try to connect the dots a bit, right? We got this, cautious optimism in the markets. People are changing how they spend their money, and the Fed is basically waiting to see what happens. So what does all that mean for, a regular person who's just trying to understand the economy and maybe make some good financial decisions?
Well, the good news is the economic data, the underlying numbers, they're not all bad. Consumer spending, even with those changes we talked about, is still a big deal for the economy. And remember how Shopify is doing so well. That's not just random. It shows that overall people are feeling okay about spending money, especially online.
So maybe it's not time to, freak out and bury all our cash in the backyard just yet.
Probably not. But I wouldn't go popping champagne and throwing a party just yet either. There are still some things we got to think about, some potential bumps in the road.
Like those high valuations we talked about. That seems like the kind of the elephant in the room, right?
Yeah, it's definitely something to keep in mind. When prices are high, it means investors are expecting big growth in the future. And if that growth doesn't happen, well, stock prices could drop.
So how do we figure out if those expectations are realistic? What should we be looking at?
That's where things get interesting. We got to go deeper than just the headlines and really understand those companies we're interested in. Are they coming up with new stuff? Are they expanding into new markets? Are they managing their money well? Asking these questions can help us see if a company's current price is actually, justified.
So it's not just about the stock price, right? It's about understanding the whole story behind it, like how healthy the company is and if it can grow in the future.
Exactly. And that takes a little research, a little thinking for yourself. Don't just blindly follow the hype or whatever's trending. Take some time to understand those companies you're putting your money into.
Great advice. It's so easy to get caught up in all the market craziness, but sometimes it's better to take a breath and really think about what's going on. And speaking of thinking about what's going on, what about the Fed? They're a big part of this whole economic puzzle, right?
Right.
What should we be watching for in terms of what they might do?
Well, like we said, they're in data mode right now. They're watching things like inflation, job numbers, consumer spending, all those key economic indicators. And based on what they see, they'll decide if they need to change interest rates.
So are we just kind of guessing what they'll do?
It's more like we have some pieces of the puzzle, but not all of them. But there are a few things we can keep an eye on that might give us hints about their next move. Like if inflation starts going up again, that might make them raise interest rates to try and cool things down.
And that would probably affect the markets too, right?
Oh yeah, for sure. Higher interest rates usually mean it costs companies more to borrow money, which can affect their earnings and potentially make stock prices go down.
But then on the other hand, if the economy starts slowing down, the Fed might lower interest rates to try and boost things, right?
You got it. Lower interest rates make it cheaper for businesses to borrow money, which can encourage them to invest more and hire more people. But it's a delicate balance. They don't want to lower rates too much and risk sending inflation back up.
So the Fed's kind of walking a tightrope, huh? Too much help for the economy and inflation could go crazy, too little and things could slow down. It's a tough job.
It really is. And that's why it's smart to pay attention to what they're saying and doing. They often give hints about what they're planning through their announcements and stuff, so it's worth following along.
So we've got this interesting situation, right? Consumer spending is changing, things are priced high, and the Fed's trying to find that perfect balance with interest rates. It's like a three-ring circus, so much going on. What's the one big takeaway you want to leave our listener with? What should they be thinking about as they try to make sense of all of this?
I think the most important thing is to remember that the economy is always changing. What's true today might not be true tomorrow. So stay informed, be flexible, and don't be afraid to, adjust your financial plans as you need to.
That's some solid advice.
Mhm.
It's not about trying to predict the future. It's about being ready for whatever happens.
Mm.
And remember, this deep dive is just a starting point. You've got some good info to work with now, and we encourage you to keep exploring, keep asking questions, and figure out your own conclusions. Now, before we wrap up, there's one more interesting piece of this whole economic puzzle we need to talk about. Okay, so we talked about the markets, how people are spending their money, and the Fed trying to walk that tightrope. But there's one more piece to think about, one that's really relevant to you, and that question about the market dip.
You mean like the political stuff, right? We can't ignore how politics affects the economy, especially this year.
Exactly. We saw how the election kind of messed with how investors were feeling, but it goes deeper than that. There's this whole debate going on about government spending, taxes, trade deals. All that stuff can make the markets uncertain and volatile.
It's like a tug of war, One side wants policies that boost the economy, the other wants to keep things stable and reduce the deficit. And depending on who's in charge, things can swing back and forth. That makes it tough for investors to figure out what to do.
So how do we make sense of all the political noise? How do we figure out what it all means for our money? It's easy to get caught up in the headlines and what each side is saying, but is there a way to cut through all that and make smart decisions?
There are a few things you can do. First, try to focus on the long-term economic stuff, the fundamentals, not just the short-term political swings. Remember, the stock market ultimately depends on how well companies are doing, not who's in the White House.
So don't freak out every time something changes in politics. Instead, look at the companies you're invested in. Are they strong? Can they adapt when things change?
Right. Second, spread your investments around. Don't put all your eggs in one basket, especially if the basket depends on one specific political outcome. Invest in different industries, different types of assets, even different countries. That way, political uncertainty won't hit you as hard.
That's always good advice, right? Whether it's politics or any other kind of risk, diversifying helps you ride out the storm.
Exactly. And lastly, stay informed, but don't let it overwhelm you. It's good to know what's happening politically and how it might affect the economy, but don't let it take over your life. Stick to reliable news sources, ignore the hype, and try to understand the bigger picture, not just the daily drama.
Tune out the noise and focus on the signal. That's how we make good decisions, right?
Exactly. And remember, this is a marathon, not a sprint. The economy and politics, they're always changing. There will be good times and bad times, but if you stay informed, stay flexible, and focus on the long term, you'll be ready for whatever comes your way.
That's a great way to think about it. It's about staying calm when things are crazy and making smart choices based on the best info you can find.
Exactly. And that's what we tried to give you today. Information, insights, and a way to think about the economy and your own financial choices.
We covered a lot in this deep dive, right? Market trends, how people are spending, the Fed trying to find that balance, and how politics plays into it all. But the big takeaway is that you understand these forces better now, and you can make your own decisions based on what's right for you.
And remember, this is just the start of your journey. Keep asking questions, keep learning, and keep exploring the world of economics and finance.
And hey, if you come across any cool research, articles, or videos you want us to take a look at, you know where to send them. Until next time, happy diving.